I've made a lot of discussion already about the married puts on the special dividend stocks and with income method number 1 in the management. The married put combination we look for, of course, is buying a stock, buying a slightly in the money put. That's maybe at least 5 to 6 to 7 months out in time to control risk to single digits, 4, 5, or 6%, while having the ability to do various what we call income methods or adjustments, from as simple as selling the call against it. Hey, you own the stock, you might have done a covered call. Even though I'm in this structure, I can do the same thing. Generate income against the position, lower that initial at risk. So maybe I'm going to go from 6% down to 5 or 4.5%. I continue to do that. I might eventually have no risk on the position, what we call being bulletproof. But that's the easiest and simplest. The put is a second working asset that I can manipulate in different ways as well. I can do spread trades inside of this that don't take on the margin requirement or special risk. Some spread trades, not all of them, and continue to lower the risk while potentially leaving the upside open as well. And in general, what we'd look for is just our default search, what's discussed in the blueprint as the limited risk structure, of course, is we're going to look to buy a stock. Let's just pick one. Halliburton's always a good one. And that's a pretty high risk, though. So I'm going to go ahead and take a look at Interactive Brokers is not a bad. That's not too bad. Interactive Brokers is at 78.71. Following the rules in the blueprint, I might consider buying the June 80 strike put, slightly in the money. It's 196 days out in time. Midpoint at 725. This would give me a total cost of 86.11, but I'm guaranteed to get 80 back no matter what happens, the worst case scenario, and that's only a 7.1% at risk. And you say, okay, well, why would you enter a position right now, basic married put position, where you're paying this extra 725 to increase your cost basis to 85.96 on a stock's trading at 78.71? You need to see a movement of at least $8, $9 to see any reasonable profit. That's not true. That's true at expiration. If I held this position all the way to June expiration, accepted no dividends if Interactive Brokers pays a dividend, and did no adjustments, I would need the stock to be trading above $85.96, $87, $88 to realize any substantial any real profit that's worth it. Really, probably above 90 to realize any profit that's worth it for 196 days. But just like when you buy a call, and this is not a parity trade to a long call, we might talk about that later, but the day that I open the position, I'm not down 6.9% or 7.1% on the position. The put doesn't go to zero. I could turn around and liquidate the position, not 101 days away, but tomorrow I could liquidate the position. My apologies. How about on Monday? Let's get it right. On Monday, I could liquidate the position, and all I'm really risking is the bid-ask spread. This option is not going to, if the stock stays at the same price to Monday, okay, it shows it's going to drop maybe down to 7.11. So it might lose $14. Well, probably not. But if the stock moves up 50 cents to 79.25, let's say, the put option isn't going to negate the gain. It's going to decline as the stock moves up, but we still have a true positive delta on the position at the start. So even if the stock just moves up 50 cents or $1 or $2, we're seeing a profit on the transaction because we're not losing the time value on the put because it's so far out in time. It's going to retain most of that time value. And it probably, with the proper structure that we use, though we don't use delta as a filter, probably only has a delta of 0.5 or 0.6. So for every dollar the stock moves up, we're only losing 60 cents on the put. And that delta is going to adjust lower. So the next dollar the stock moves up, we might only lose 55 cents on the put. And the next dollar, we might only lose 50 cents on the put. But as I mentioned, we still have the ability, of course, to sell premium. I never do this right away, and that's discussed in the blueprint. But I could just do a simple income method number 1 and sell a call against the position. Let's just say we generate $1.40 against it to keep the math simple. And I take my risks down from 6.9 to 5.4. Now it has a peaked gain on the position. That's what you got to watch out for. That's why we typically don't sell the call right away. We wait for the stock to move up to either look for a better premium or to look for a better strike price where we don't see this gap down with 2 ways to lose if the stock maybe goes to where our target price was in the first maybe 50 to 60 days or so. Although this call is only 14 days out in time. But this is not what I got caught with in ANET, but I almost got caught with in the ANET position that's available, that's posted, of course, in the Fusion portfolio at Radioactive Trading, as well as the NEM position. But let's go to the portfolios here. There's our NEM covered call, but we want to take a look at, I think it's still here. Yes, it is. There we go. This is the ANET position as of Monday. And as I mentioned, the stock had moved up pretty much right to about here. So where if the stock hit my target and stayed at my target around 133, maybe a little bit above at 134, 132, we were looking at a $500, $600 return or so per share. And if it was right at 133, we're at 635 max profit. That's including the remaining price in the put based on the Black-Scholes pricing model. We gave up almost 2/3 of that with the stock going up to this price. This isn't an improper structure. Good controlled risk of 4.2% with a max return of 4.7. I like the structure. That was mentioned when I entered this. But again, when it was up here, it was going to cost me $7 or $8 to buy back that call. If I wanted to roll for a credit, which I'd like to do, I hope to do, this would have put me almost beyond the put expiration price. I could have sold the 138, 139 at the money call from March and gotten a reasonable premium, but that's where my put is. I didn't want to necessarily do that. But interestingly enough, I didn't overreact to that gap up, the big gap that happened. That was on Wednesday in the Powell speech. We went from right where I wanted to be at 133. Let's take this down to just 10 days, shall we? It's going to make me go hourly, isn't it? Okay, that's fine. So the last half of the day on Wednesday, that's what we're looking at here. After the Powell comments, most of us saw the market do this and our stocks do this. ANET just went up. It was hourly, but every hour we jumped another strike price. 136, 137, 139. Yeah, peaked out at 140.50, kind of settled down, but then came right back to it. At I think it was at this point, it was a $8.75 buyback cost on that call. Now, I did collect $3.85 for it. Don't get me wrong. I did have that in my pocket. That was good. The buyback cost here was extremely high, but I didn't panic and try to roll as soon as it went in the money, because with this type of movement, hey, if I rolled from my 133, said, oh no, I got to go up. Let me go up to the 138. And then, oops, now I got to go up to the 140. It's harder and harder to roll for a credit as it's running. So let it run, and then it settled. And then today, of course, was based on a different sort of concept. Of course, it was based on the idea or what came out in the news about the jobs report and strong market and everything. We pulled back down. But to be honest with you, I was hoping for this, but I kind of expected this. Not even related to the jobs report that came out today. It's just been this new condition. It's been this new market that even without a rate hike, this happened, in September. We saw this happen, I think, in July. Well, I think we saw it happen in the first time really was March. Powell comes out and speaks about his concerns before a rate hike even happens, and we see a sudden afternoon gap up or disastrous gap down. And then a day or two later, we're close to a range back to where we were. We don't make it back all the time, but there were several times where we saw a big gap, and then a day or two later, the market just said, okay, he made his comments and we're good. This one was the gap up. I didn't expect this to keep going because that's just what's been sort of the new market with these the focus on the rate hikes, inflation, as well it should be, don't get me wrong. But He speaks, says what he has to say, says what he's planning and what the Fed believes they're planning for the markets, and it goes one direction or the other. And then sure enough, it comes back down a little bit, or it drops down significantly. And then it comes back up again a few days later. Market kind of shrugs it off. So I didn't roll at the high price because I was deep in the money. Was I risking having an early assignment on that short call? Yes, I was, but I was prepared to do that. And I was prepared for an income method if the stock even stayed in this range. I wasn't going to buy it back. I was going to let it be assigned, then do something in the blueprint called income method number 7. But I didn't panic and I didn't have a knee-jerk reaction just because that's what we've seen in the last 8-9 months since March, when the rate hikes and every time he speaks, there seems to be some expectation and some pouring in of money or pouring out of money. But then we kind of shrug it off a little bit. Now, yeah, the MACD is still affected. It's still showing a downturn here. We're still below the SMA 20 after that big drop down today. But again, it's what I expected. So I was, long story short, I was able to roll this easily for a credit. I rolled up to, I believe, to the 137 call for December 16th. And let's just, how would I do that here in the portfolio? Well, I did it in my account. So I'm just going to go to roll leg. And I was able to buy this call back this afternoon at 180. The best time was this morning. Oh, this morning, this call, the stock had dropped down with that sudden drop. I'm watching it in the first half hour. I had a coaching session at 10. But I think it was around 10.15 or 10.20. I could have bought this back for almost 90 cents. I took in 385 initially. But then it started to come back up as we saw on the chart. So I missed the opportunity, but I wouldn't have gotten as good a call premium. That's what I did. So I went to December 16th. We went to the 137 call. And it was, I want to say I got 290. Yeah, I did. I'm pretty sure I bought this back at 180. In the money at the time. The stock was at 134.50 or 134.60, and we rolled here to the 290, so give us another 110 in profit on the position, but with $4 higher strike price. It only lowered the risk slightly from where we saw before. We're down to 3.5%, but if the stock now is trading up at 137, it'll make 6.9%, where we're about 5.4% on this position. If I let it be assigned or liquidated it today. So for 14 days, I didn't mind that increase, up almost about 2%. I'm sorry, it was 5.6, 5.8. I'm sorry, it's 5.6, 5.8. So for 14 days, a 1.1, 1.2% gain max, with managing to lower the risk a little bit down in price as well by that credit. So this is the type of structure I want to see with the ANET position, not the one we were looking at initially, or the married put with the call sold immediately we looked at on the IBKR position. I also did the same thing with NEM. Oh, I'm sorry, that was not where I wanted to go. NEM here was the 47.5 call. I didn't record it here in the presentation. This one expired, and we rolled to the December 2nd. Well, let's just do that. I'm going to have to expire the leg on NEM. And then what we did do is, I think it was Monday. Yeah, it was a 5-day trade. So we sold the December 2nd call, 47.5. Oh, it hurts when you see it sometimes, doesn't it? It was only 30 cents. The stock was at 44.80 at the time when I did this. So I figured, hey, 5 days, 30 cents, 0.6, 0.7% return for a 4 or 5 day trade. That was, again, also opened on 11/28. Why not? Why not just milk it for everything it's worth? It's not that I forgot about the Powell announcement, but I didn't expect the jump that we saw. I should have, maybe, but it also could have gone down as well. 119 buyback cost. During the day, I was able to buy this back for 78 cents, and we rolled to the December 23rd, I think. Let's just take a look real quick what I did there. I'm sorry, I have to go back to radioactive trading. I know you're not seeing the screen and you're hearing me click, so just give me one moment. There we go. Okay. So yeah, I didn't do too much here. I did okay on the risk. It only lowered it by 0.3%. Now this looks like I lowered the risk by 1.8%. That's not accurate. this is where we were with a 30-cent call sold. If we got the full profit on it, we had a risk from 7.4%, opened on September 30th down to 3.3, with a good strong profit at the time of when we sold this, of potentially 4% or so, 4.5 or 4.2%. But we had to buy it back. Now I got a good price at 78 cents, but I had to go out. Oh, it only was the 16th. We rolled up to the 49 call, which is right at the money, taking advantage of the at the money bell curve, as you guys have heard me talk about before. Not 90 cents. I only got 12 cents of credit for it, but it will increase the potential profit in this case, because we'll also get an extra $1.50 if the stock remains or stays at $49. But this is 14 days away. We see another move like we did, I may or may not have to roll this position. If I want to stay in it, I'll roll it. If not, I'll let it be assigned and use that other income method I mentioned, income method number 7. But I'm okay with this. A risk with 3%, and we have a good potential max return on the position. We could liquidate right now for 4%, and at expiration is potential 5.8% return if the stock remains almost right at the money at 48.67. So I like that risk-reward ratio almost 2 to 1. I should say reward to risk as opposed to risk to reward. And I still have a good 120, 130, 105 days out in time now with protection in place with the adjustment. Now that's the ANET position. So just some of the things and some of the concepts that we do with the married put position. The risk is always controlled and always in the single digits. Then we use those income methods to enhance our performance, lower that initial risk further, and potentially earn extra profits, which we did both cases.